Okay, good afternoon, everybody. First and foremost, thank you very much for taking the time today to come on I think it's our fourth webinar this year. Today, we're very much focusing on property and the various reliefs available to property investors, which is always a topical area of debate with our client base. We have our head of property taxation, Russell Bennett, talking you through some of the key aspects today. Just before I run through that agenda and hand over to Russell, just a basic point of housekeeping around, we've got you all on mute today. And so if you want to ask any questions, and please do ask questions as we go, we'll be pausing to take those questions 3 times during the next 45 minutes. Please just put them in the chat and we'll put those questions to Russell. So in terms of what Russell's going to talk you through today, we're going to cover the basics, which I think is always a good place to start. Specifically, what are capital allowances, and why do we have them in the first place in the UK, how they work in practice, the types of allowances and reliefs, of which there are numerous. We're going to bring all of that to life within a case study. So once the basics are done and understood, we'll be moving on to the more topical areas of capital allowances, including the super deduction that was introduced not so long ago by the former Chancellor, and whether that's been a success or not. We've obviously had all the press around the September mini budget that happened recently, some of which included updates on capital allowances, which Russell again will talk you through. And then finally Russell will talk you through the latest status of the ongoing Treasury consultation into capital allowances generally in the UK. So without further ado, I'll hand over to you, Russell.
Okay, thanks, Matt. Hello, everybody. I'm Matt Said. I'm head of the property service line for Claritas. I'm actually a chartered surveyor by training rather than an accountant, so I can bring that kind of property and construction industry expertise to capital allowances, which is actually, as we'll see, is a very helpful thing to do. I've been a capital allowances specialist for 20 years now, which makes me feel a lot older than I'd like to admit. So starting off with capital allowances, how do they work fundamentally? I mean, this is clearly a hugely simplified run through, but from your accounting profit, you have to add back depreciation, and then you can deduct capital allowances or land remediation relief from that to arrive at a profit chargeable to tax. So capital allowances reduce the amount of profit you pay tax on, and that's how you get the benefit from the relief. They're based on the original cost of an asset, not on the accounting treatment. Like I said, I'm not an accountant, but I do see a lot of accounts adjustments, revaluations, clever things that accountants do that I frankly don't understand. A lot of clients try to convince me we should claim capital allowances on an inflation adjusted cost or today's value for a property rather than what was actually paid for it 5 years ago. None of that is relevant. We need to look at the actual cost that was actually paid for an asset on the day it was purchased. So we need to go back to the original cost of something. Clearly, therefore, a good claim relies on good record keeping. Time and time again, I see ledger narratives that will say, as agreed, or we'll have an invoice from Jewson's for building materials, which doesn't really tell me anything at all about the asset or the building or how to treat that for tax purposes. So right from the very start, if you're buying something that you may want to claim capital allowances on, or frankly for any kind of tax assessment later down the line, it needs a meaningful narrative on the invoice and on the ledger. A strong positive for capital allowances is that, with only a couple of exceptions, there's no time bar, which means you're never timed out from submitting a claim. I've done claims. A couple of years ago, I did a claim for a site that was bought in the early 1990s. It was still owned by my client. They'd held it since they bought it, and it was uninterrupted ownership. So we were still able to submit a claim in an open period. There's no point at which you're out of time. Clearly, inflation's done its work, and with inflation as it is at the moment, it will affect more and more, because we're based, like I said, we're based on original cost. But so long as the underlying assets are still owned in an open period, a claim can be made, and the claim is submitted with a tax return. Okay, next slide, please, Matt. Okay, I do like my memes, so I thought I'd put this up here, a bit of light relief. We should all be wary of where we fall on the evasion, avoidance, evasion spectrum. Capital allowances aren't really anywhere on there. They're kind of dropping off the bottom of that scale. It's kind of on the avoidance spectrum, much like investing in an ISA or a pension. You're accessing a government incentive. This is something the government wants you to do. It thinks it's good for the economy. It's encouraging you to invest in plant and machinery. So while it does reduce your tax bill, there's no implication that there's any kind of avoidance going on here at all. Next slide, please. Allowances were introduced just after World War II as an incentive to get the country back on its feet economically. And there have been several different types over the years. Currently, there's 4 main types of allowances. There's plant and machinery allowances. All of these I'll go into in more depth in a couple of minutes. Plant and machinery allowances are kind of the main one. They're the ones that everyone thinks of first. Also, fairly recently, we've had structures and buildings allowances. There's research and development allowances and and an annual investment allowance. So there's 4 main categories that I'll cover. Can you click the button for me, Matt? Thank you. So these types of allowances, they're only available on commercial property, but they are available to any entity that pays corporation tax or income tax. By commercial, it basically means anything that isn't residential. And as with most things in the UK tax regime, it's not clear-cut what counts as residential. There are 2 or 3 different definitions of residential just for capital allowances alone, let alone every other type of tax out there. So the main grey areas around there are residential blocks. Excuse me. For example, a block of flats, everything behind the flat door will be deemed to be residential, but everything this side of the door, so the lift lobbies, reception areas, any laundry rooms, if it's a high-end block of flats, if it's got a gym or a swimming pool or a basement car park or something, all of that shared communal space would not be caught by the definition of residential, so allowances are in point on that. And there's actually usually quite a lot of plant and machinery there. Certainly if there's a swimming pool, there's a lot of plant involved in a swimming pool. Lifts aren't cheap, and there'll be lighting and heating in the communal core spaces. HMOs, houses of multiple occupation. There seems to be a misconception that there's a grey area here. There isn't really. It's fairly clear cut. HMOs are residential, so there's no real scope for capital allowances there. Student accommodation is an interesting one. Back when I was a student, I had a room and the toilet was down the corridor and the kitchen was on a different floor, and I thought myself lucky. Students today, obviously the youth of today don't know they're born, do they? They all want ensuite rooms with a kitchenette that all provide the requirements for independent day-to-day living, which is the phrase in the key phrase in the legislation. And if it provides the facilities required for independent day-to-day living, it falls under the definition of residential. So again, much like flats, if it's behind the door of the student room, it would be treated as residential. But there's still a lot of scope. Student accommodation these days has shared study areas. It all has gyms. There are socializing spaces with, TV rooms, a games room, that kind of thing. All of that is a shared space. It's not residential, so allowances are available on that. And the final point there, a little bit of an interloper because it's not a capital allowance, but it is tax relief on property development, is land remediation relief. This is available on residential or commercial developments, but only for corporation tax payers. So I'll cover all of those in a bit more depth shortly. Do we have any questions so far, or are we all clear on that?
None so far, Russell.
Okay, excellent. So can we have the next slide then? Thank you. So loose plant and machinery or chattels tends to be fairly easily understood. It's furniture, it's computers, it's the machine on the factory floor that stamps out the widgets. That's all fairly straightforward. If you can click the button for me, Matt. And again, just do a couple more clicks. Thank you. Fixtures are where it gets complicated. And that's where we start to step outside the expertise of a generalist accountant and where specialist advice can really add value. In land law, anything that is fixed to a building becomes part of that building. And therefore, as buildings, apart from recently introduced structures and buildings allowances, which we'll come to, buildings don't attract tax relief. The reason being that buildings tend to go up in value over time, so there's no necessity for any tax relief to offset the depreciation. So anything fixed to a building is thereby part of the building. Capital Allowances Act 2001 has my favourite chapter in it called Chapter 14 that acts to counteract that. And it allows fixtures, or certain fixtures, to be treated as plant, even though they are affixed to a building. They need to be categorised into two different categories. There's the special rate pool that was introduced in 2008, mainly for integral features, electric systems, lighting, cold water systems, heating. Although the special rate pool also is where you would put solar PV panels or thermal insulation, for example. Then there's the main pool or the general pool. It goes by any name because there's nothing actually specified in the legislation to describe it. It's just stuff that isn't special rate pool. That's where everything else goes. That's your fitted kitchens, sanitary ware, that kind of thing. Anything that's fixed to a building that could be plant and machinery that isn't special rate pool would be in the general pool. Incidental works are an interesting one. There's a scope in the legislation, and again, this is where someone such as myself could really add value, where you can dig into the cost information. If you imagine a scenario where you have a plant room in a building with a big air handling unit in it that's had the plant room built around it. If you need to replace that air handling unit, you need to demolish the wall to get it out, and then put the new air handling unit in and rebuild the plant room wall around it, replaster it, redecorate it. Any of those works that are incidental to installing that piece of plant can follow the treatment of that piece of plant for capital allowances. So in that example, the air handling unit would be a special rate pool item because it's part of the heating and vent systems for the building. The demolition and rebuilding of the wall would also be special rate pool expenditure. Now, if that's as a standalone project, that's fairly straightforward. It won't be, it'll be done as part of a general refurbishment of the whole building. So you'll need to have somebody who can identify what proportion of the costs of that refurb are specifically attributable to installing that air handling unit. And that's where somebody who's trained as a surveyor will be able to measure out the amount of brickwork, the cost of that, allocated cost to the plastering, to come up with a supportable claim for works incidental to installing that air handling unit. And there's no cap on that. If the incidental works are 10 times the cost of the piece of plant, it doesn't matter. You can claim the entirety of the work so long as they are wholly incidental to installing that piece of plant. CAs have been around, like I said, since the Second World War. Lots of case law has happened in the intervening years. There's the premises test, and Matt, if you could click once more, thank you. We have the function test as well. These are the two key tests. There are others. These are the main ones. The premises test asks us to consider if an item is something with which a trade is carried on, or if it's just the setting within which the trade is carried on. And that gets you into some quite philosophical debates, and it's still coming up in case law today. There's been recent cases about a potato storage facility, about a greenhouse, about gas storage cavities in naturally occurring holes under the ground that have been pumped full of gas to store the gas in. Is that cavity something with which the trade is being carried on, or is it a setting within which the trade is carried on? Now, the prime example I use on this from my personal experience, I looked at an anaerobic digester, and there was some heavy duty machinery. It would deal, you know, you'd have bin lorries come in full of waste, tip it into this machine that would do the digesting, process the waste, and come up with an output. All of that could quite happily have happened outside. It didn't matter if it got rained on or snowed on or anything. But it was in a building. And traditionally, the building would not be eligible for plant and machinery because it's just a building. It's somewhere within which the trade of anaerobic digestion was carried on. However, when we investigated further, it turned out that the building was there as a planning requirement because this was built in a residential area and it was necessary to keep the smell in, basically. So the building did perform a function in the trade. It was something with which the trade was carried on because it kept the smell in, and without that you wouldn't have been allowed to do the process that was being done. So the walls and the ceiling and the roof for this building did perform a function in the trade and passed the premises test. The function test is kind of similar, related in many ways, but slightly different. And again, that asks the nexus to the trade. How closely connected to a trade is a piece of plant? And as you can imagine, case law leads to some bizarre results. The best bizarre result that I've ever come across is carpet tiles. Normal close fitted carpet, you can lift it up and remove it, take it to a new site. It retains a separate identity, so it isn't part of the setting within which the trade is carried on. Carpet tiles, however, can be reconfigured and taken away, and therefore again aren't part of the premises unless they're glued down. If they're glued down firmly, they become part of the building and can't be removed without altering the identity of the asset or the building. And case law has established, therefore, that carpet tiles are part of the premises and fail the premises test by being part of the premises within which the trade is carried on. So, frankly, it comes down to the point where the strength of the glue used to attach the carpet tiles determines the tax treatment of the carpet tile itself, which is crazy, but that's where we are, and it's where we've been for a long time. Nobody's bothered to challenge that in case law. Next slide, please. A couple more clicks. Thank you. As a result of these case laws, there are assets that are eligible for one owner and not eligible for another owner. I mentioned the special rate pool. This was introduced in 2008 that made more assets eligible for capital allowances that weren't previously. So you then potentially have a scenario where an owner bought a building in 2007 and didn't have entitlement to the cold water systems or the electric systems because at that point the legislation said they were ineligible. If they sell that property in 2009, the new buyer in 2009 has entitlement to those assets because they are eligible because the legislation has changed. And that gives rise to overage claims where the new buyer can claim an unrestricted entitlement to allowances on those assets that weren't eligible in the hands of the prior owner. We can also see that there are some assets that may be eligible in one trade but not in another. Decorative assets is the best example there is of this. If you're in an office and there's a picture on the wall, it doesn't really do anything. unless it's one of these motivational things that says, you know, there's no I in team or whatever. It tends to just be a picture on a wall. Whereas if you have the same picture on a wall of a restaurant or a hotel or a pub, it's part of creating the ambience and the atmosphere that draws customers in from the street. So you're creating an atmosphere in that site that's part of the trade. It forms a function in the trade, and thereby those assets that contribute to creating that atmosphere can be deemed to be performing a function and therefore planned in that trade. All of which means, and the question I'm asked most often is, can you just give me a quick list of what's eligible plant and what isn't? Now, no, I can't, for two reasons. Firstly, it put me out of a job and I have a mortgage to pay. But more importantly, there isn't a simple tick list of assets. Like we've seen, it depends where the asset is, who's using it, how it's being used, how it performs a function in the trade. There's no simple, straightforward yes, no tick list to this. Everything needs special consideration based on the individual case at hand. And it's also necessary, the last point there, thought needs to be given to descriptions. How you describe something in your tax return, it's about strategy. Basically, if you describe something in terms that suggest it's part of a building, HMRC may query that. If you describe it in ways that suggest that it performs a function in the trade, that it's a separate asset, you're a lot less likely to find it being queried, and it's going to be a lot easier to defend it when it does. So be careful of the wording that you use to describe things. Okay, thanks, Matt. There's two main types of project that I tend to get involved in. The first one is construction projects, and by construction I mean fit outs, extensions, renovations, refurbishments, as well as bare site builds of property. Main factors that we need to consider here are the timing of the allowances. When are allowances claimable? If the building is being built in an SPV that has no existing trade, the allowances become eligible on the day the trade begins. If there's an existing trade, you can claim allowances as the building is being constructed, as it's an asset under construction, based on the day the expenditure is incurred. And that doesn't really matter if you have a shop in Exeter and you're building a new shop in Newcastle, it doesn't matter that they're so far apart. There is an existing trade in that entity, in that limited company, let's say, that's running the shop in Exeter and it's expanding into Newcastle. All the fit out costs of the Newcastle shop would be eligible based on the day the invoices were raised or there was an obligation to pay. Second point there is projects that span accounting periods. Now, I know accountants tend to think in year ends. Anybody who's watched an episode of Grand Designs know that building projects don't conform to plans. They certainly don't fit within year ends. There's usually preliminary expenditure, design fees, all that kind of stuff that happens before the construction phase. Then you have the construction phase that takes as long as it takes. It can be a couple of months for a small project. It could be a number of years. And then afterwards, there'll be tailing off of expenditure. Retentions are released when defects liability periods expire. And there'll be final bits and bobs of expenditure that come in, bits of furniture that need to be built. Landscaping is normally the last thing that takes place for obvious reasons. So thought needs to be given to when you do the analysis, when you submit the claim. It's possible to do an analysis every year end. You can do an analysis every month if you want to. You can do an analysis every year end, submit claims year by year as the project goes along. Clearly that costs a lot more money because you're revisiting the costs every year for every report. You also will end up making retrospective adjustments as costs that weren't eligible become eligible as the project continues. It does, however, it's cleaner and easier if you do one analysis at the end of a project when all costs are known, and you just look back at how much the building project cost and split that out and then allocate it to year ends. The downside of that is that you miss out on some cash flow of some allowances. The relevant interest is also a key point here. For a valid claim, the entity needs to have the relevant interest at the point the expenditure is incurred. Now, that's a kind of nuance that's often missed, and it can cause trouble with where there's an opco-propco structure, where a property company owns a freehold in a building, but it's being fitted out or refurbished by the opco that occupies it, that happens to have cash in its bank account to pay the building contractor. If the opco doesn't technically have an interest in the land, doesn't hold a lease, it's just allowed to be there by the propco, that can result in a loss of allowances. And this needs to be addressed up front. You need to get ahead of this, because you can't retrospectively insert a lease after the project has been finished and this problem has come to light. The interest needs to be there at the time the money is being spent. And this has tripped up lots of people in the past, and it's something that really does need to be flagged up. If there's an opco-propco or any kind of group structure going on, you need to make sure that the relevant interests are in place before any invoices are paid. The second main type of project is acquisitions, buying a property second-hand. There's a number of dates on there. You can track through those dates the Treasury's and HMRC's attempts to restrain rogue claimants from submitting claims where they didn't have entitlement. The legislation is tightened up 3 or 4 times, well, 4 times over the last few years. Does it work? Not really. All it means is that people who ignore the legislation have more legislation to ignore, and people who play by the rules find it more and more difficult to navigate. What it does mean is that we now need to track the ownership of a property as far back as possible, certainly if possible back to before July 96, to establish who has owned the property, when they've sold it, and how much they sold it for at every transaction. Now that can be, going back to 96 is a long time ago now, that can be many, many transactions that we need to try to establish and track through. Almost inevitably, we're so far down the line now that there will be a gap in the fossil record, and we won't be able to completely establish how a property has been built. And it's possible that HMRC have tax records that they can rely on, we don't have access to. But if you can navigate these dates, if a property has been built more recently, that limits the amount of time you need to go back to, obviously. A claim can be made on a second-hand property. If you spent money on a property, a proportion of the purchase price will be for the land, a proportion will be for the structure, and a proportion will be for the plant and machinery in that building. So what I would do there is I would do 3 different valuations, value the plant, value the land, value the building, and do undertake an apportionment to establish how much of the purchase price related to the plant. And this is one of the few times where inflation actually works in our favour, because this is based on the amount of money you've paid for a property. And obviously, if you bought a property in 2015, it's going to be worth a lot more than if you bought it in 1995. So you do benefit from the rise in property prices if there's clear entitlement here. Matt, can you do me another couple of clicks? Thank you. Overage claims, we've discussed. Vendor paid to pool. This can be where a vendor hasn't pooled their allowances, hasn't claimed their allowances, but wants to sell a property. A buyer can prepare a claim for the vendor, step into their shoes, prepare a claim on their purchase price. The vendor then agrees to pool those allowances and transfer them to the buyer. It feels like a bit of a workaround, and it is a workaround. It's because the legislation was drafted in a hurry and didn't consider every possibility. It's perfectly legitimate. HMRC do not have a problem with this kind of exercise. If you've got a vendor of a property who hasn't claimed, isn't interested in claiming because they're loss making or they're not tax paying, this is a way to access the value of the allowances that would otherwise be lost. That's about it for plant and machinery. Before we move on, are there any questions on P&M? Matt,
Not at this stage, Russell, no.
Okay, thank you. Can we have the next slide, please, then? Brilliant. So structures and buildings allowances. These were introduced in October 2018 by Philip Hammond. Does anybody remember him? It was only 4 years ago. We've been through a fair number of chancellors since then. It feels like an age ago. Structures and buildings allowances emerged from a review by the Office of Taxation Simplification and are the most complicated, unnecessarily complex type of allowances I've ever come across. So I'm not sad to see the OTS being disbanded based on my experience of SBAs. If anybody has long memories, you'll remember the industrial building allowances that were phased out back in 2011-ish. And this is kind of a rebirth for IBAs. You're not restricted to just industrial buildings, it's any structural building. And it provides tax relief at initially 2% for over 50 years, or more recently 3% over 33 and a third years from the date of first use. Now that's the first deviation from expected norms of capital allowances. Normally capital allowances are available from the day the expenditure is incurred, not from the date of first use. The second deviation is the clawback against capital gains tax. Structures and buildings allowance reduces the base cost for CGT. Now, until 2018, I'd spent 17, 18 years trying to convince clients that claiming capital allowances didn't put them in a worse position for their CGT. Except now with structures and buildings allowance, that is a consideration. It's not available on plant and machinery. There's a specific line in the legislation that says that. If you do remember IBAs, it was a perfectly valid strategy to say, look, I'm not going to bother splitting out the cost of plant and machinery. I'm aware I'll lose a little bit of cash flow, but it's easier and simpler just to claim the IBA on the entire building cost rather than separate P&M. Now you can't do that. But that does raise the perverse possibility, in theory, that HMRC could reject a claim for SBAs at 3% on the basis that part of that expenditure should have been claimed at 18% as a plant and machinery allowance. Now, I can't see that ever happening, but in theory, it could. Why that that paragraph in the legislation was inserted, nobody knows. These are hugely complex. There's not been a lot of guidance, and the lack of case law suggests to me that most taxpayers just aren't bothering to claim them. The admin burden is so high and the benefit, as you can see, is so relatively low that for most property investors, they're simply not worth the cost of claiming. And this was something that we fed back in the consultation, but hasn't really been addressed. Next click, please, Matt. Okay, thank you. Research and development allowances. This is the capital version of the revenue reliefs for research and development expenditure. It's a 100% first year allowance for providing a facility in which research and development is carried on. Interestingly, if the use changes, there isn't a clawback for R&D allowances. The case that I worked on this was a veterinary vaccine facility that had been built to develop a vaccine for cattle, I think. And the plan was to spend 3 or 4 years developing and testing this vaccine. And once it was successful, once it got signed off for use, they were going to convert the building into a production facility. So they claimed tax relief on the R&D facility, perfectly legitimately, because they were carrying out research and development. But when it was converted to a factory, it was no longer in use for R&D. There was no mechanism in the legislation to claw any of that relief back, which I found surprising at the time, but interesting and worth noting. Next slide, please, Matt. Thank you. So the annual investment allowance, this is the final one we're going into in depth. This has become known as the yo-yo allowance over the years. It's been 50,000, it's been 200,000, it's been 500,000, it's currently $1 million. It was due to drop to 200,000 from the end of next March, but as we'll cover shortly, that's been changed. It's the allowance is shared among a group, however the group sees fit, basically. And whenever the value, the amount of the allowance changes, there are very complex transitional rules. As with everything, it's never as straightforward as it should be. But again, thankfully, that's kind of gone away now. The annual investment allowance gives 100% tax relief on the first £1 million of qualifying plant and machinery expenditure. But this gives rise to the need to plan and think through how you're allocating your annual investment allowance. If you're claiming the super deduction at 130%, for example, there's no point claiming the AIA at 100% on that plant and machinery. You need to, prioritize. There's kind of a waterfall approach where you claim the 130% on the plant and machinery first, then allocate your annual investment allowance to the lowest rate of relief, normally the special rate pool items at 6%, and then up to the main pool items, and then SR allowance and so on. So there's some thought that needs to be given to how that's actually allocated across the expenditure as well as within a group. Okay, at that point, I think we should pause for questions. We've rattled through quite quickly. Are there any questions that have come up?
Hi, Russell. Yeah, I think we've got a couple which seem to be interrelated, possibly from the same listener. So I'll go with the first. There used to be ECAs for environmentally friendly plant. Are these still available?
There did used to be ECAs. ECA stood for Enhanced Capital Allowances, and it was a 100% allowance for environmentally friendly plant. So there was a government list of plants that saved energy or water, and if the item that you bought was on this list, you could get 100% allowance rather than just the standard 18%. They were withdrawn in April 2020, and at the time nobody could quite believe they wouldn't be replaced by some other kind of environmentally green tinted allowance. But they haven't been. They've just been taken away. They weren't as beneficial as you would have hoped. There was a lot of admin involved in claiming them. You had to establish the model number and the purchase date of each individual pump or air conditioning unit, all that kind of stuff. There was a lot of admin involved in supporting a claim. But no, they have been withdrawn a couple of years ago. There is still an enhanced capital allowance lingering around on electric vehicle charge points. That's the only thing that still gets an ECA. But interestingly, the Section 25, the works incidental clause would still apply to that. So if, for example, if you're installing a car charge point in a car park and you need to dig a trench through the car park to install the cable and then re-tarmac over, all the trench digging and re-tarmacking work would also attract the ECA because it's incidental to installing the charge point.
That's great. Thanks, Russell. I think this second question relates to a point on the previous slide regarding research and development allowances. So I'll ask that question. What about desk-based R&D? Does this qualify? And what if only part of the time spent at the desk is on R&D work?
Yes, yes, it does qualify. So long as it meets the definition of R&D, then we're happy. The legislation was drafted, I mean, it's 2001, which doesn't feel that long ago, but actually was. The legislation was drafted at a time when R&D was envisaged to be people in lab coats with Bunsen burners and test tubes. Things have moved on since then. A lot of R&D can be done at a desk on a computer, software development being the obvious example. That still, if it hits the definition of R&D, that would still qualify. The issue with that is that, like I think the question asked about if a proportion of the time is spent on non-R&D activity. The legislation is drafted to make sense if you look at a floor area. So ideally, what you'd have is you'd have a desk with a computer where R&D was done, and when that employee started doing non-R&D work, they go and sit at a different desk. Clearly, that doesn't happen. HMRC do actually accept that the legislation is a bit out of date on this. It's way at the bottom of the queue for being redrafted. So I think the best workaround that I've never seen queried by HMRC generally is accepted practice, where you would assess the amount of time that desk is used for R&D and claim that proportion. So if a desk is used 20% of the time is R&D and 80% of the time is non-R&D, you could claim 20% of the cost of that building against the R&D allowance. It's not ideal, it's a bit of a fudge, and you may, in the first instance, you may get a job's worth officer who argues that that's not eligible, but I've never seen that argument stand up. We've always been able to claim on desk-based R&D on a percentage basis.
That's great. Thank you, Russell.
Okay. Okay, yeah, so moving on to land remediation relief. Like I said, it's not technically a capital allowance, but it is available to corporation taxpayers. So if you're a JV or a income taxpayer, this isn't, you wouldn't get this, but each individual partner, if they're a corporation taxpayer, each individual partner of the JV would be able to claim. And it gives 150% relief for CapEx or 50% for revenue expenditure on land remediation. The 150%, clearly that's a first year allowance, so you need to be on the ball with claiming this. It's not like CAs where you've got any amount of time to submit a claim. And the revenue, the timing of revenue relief is very complex, particularly where developments take place over a number of years, and a site is remediated for a number of years, and then the costs of that remediation only hit the P&L when an individual plot is sold. So from that point, I think you have 2 or 4 years, depending on the specifics of the case, to claim the revenue relief. There's an interesting opportunity here where if land remediation relief creates or augments a loss, you can surrender that loss in exchange for a tax credit of 16% of the cost. So that's actual cash money back in from HMRC. The 2 main conditions: you must own a major interest in the site or in a neighbouring site. And that's an interesting one where, for example, if you're redeveloping a site that neighbours, for example, a petrol station, and there's an oil tank on the petrol station that's leaking oil into the ground, there's clearly the possibility that that oil could leach through into your site and create a problem. So if you then clean up the petrol station, replace the oil tank, clean up the oil out of the ground, land remediation relief is available to you, even though you're cleaning up a neighbouring site. Land remediation relief is available on the remediation of land contaminated by an industrial process. So if we have another click or two, yeah, thank you. So remediation basically works on what's called a source pathway receptor model. So you either need to remove the source, i.e. dig the nasty stuff out of the ground, or you need to sever the pathway. If digging the nasty stuff out of the ground isn't possible or isn't cost effective, and you choose instead to put a concrete cap, let's say, on that piece of land to keep the nasty stuff in the ground, you're severing the pathway that amounts to remediation. An industrial process construction of a building qualifies as an industrial process, which is how the removal of asbestos or the encapsulation of asbestos attracts land remediation relief. And that's the majority of the claims that I see are for removal of asbestos that you come across during a refurbishment of a building or demolition of a building. There's a couple of specific exemptions from the requirement for the industrial process. Japanese knotweed being the obvious one. It's a pernicious thing that's so hard to get rid of and very expensive. There's a specific exemption for that, and naturally occurring gas such as radon. If you need to install gas-proof membranes in the foundations of a building to protect the occupants from radon, that will be eligible for land remediation relief. Okay, next slide, please. We have a few planning opportunities here, what to look for. If you or a client are looking to expand or relocate, the sooner you give thought to tax in general, but to capital allowances in particular, the more favourable the position can be. I'm always asking accountants to look for indicators in the accounts. If you see a client is spending money on architects' fees, what are they up to? You know, have a conversation with them. The sooner we can get ahead of this, the sooner we can advise, the better. So if you see something that indicates that a client may be looking to build a new project or relocate, if there's, you know, industrial agents or estate agents fees, that's the time at which to start thinking about capital allowances. Next slide, please. Great, thanks. So current projects. If you're working on a construction project at the moment, there's the scope to design that project to be tax efficient. Normally actually quite very little cost. There's also scope to relocate or to look for a site or a location in a specific area that could be more tax efficient. And I'll come on to a couple of examples later. It's always wise, if possible, to include clauses in construction contracts that guarantee that the construction contractor will provide the information that you need to support a rigorous claim for capital allowances. Very often we'll see contractors argue that cost information is commercially sensitive, or they've actually, more often, they've finished the build, they've moved on to the next project, they've either archived or lost the cost info for the project we're looking at. It's not fatal. Someone like me can come along and estimate a reconstruction cost. That's kind of what I do. That's where the surveying skills come in. But clearly it's going to be better and more robust if a claim is based on actual known construction costs. HMRC can't really argue if you have a priced bill of quantities in front of you from the contractor saying this is how many bricks we've put in the building, this is how much concrete we've put in. You also need someone to liaise between construction and finance teams, ideally, someone who can speak the language of both, because very often construction teams look at upfront capital cost rather than post-tax cost. And if you've got two options that give you two different tax outcomes, the cheapest one pre-tax may not be the cheapest one post-tax. So there's scope for someone on the project team who understands capital allowances and tax to get everybody talking together and to actually look at the bigger picture rather than just their own individual little department. Retrospective catch-ups. I'm actually working on a project at the moment where we've got a multi-site operator with shops across the country, and they haven't been sufficiently profitable to consider capital allowances to date. But actually we're looking at, like I said earlier, there's no time bar on this. We can go back as far as we need to. So we're looking on a catch up for all the allowances that may have been missed. Purchases, like I said, if you're buying a property, we need to consider early and correctly how capital allowances are addressed. So the next slide, I think, will explain, is a case study that explains why you need a capital allowances advisor. This was I'm aware I'm running a little bit late on time, so I'll try to skip forward a bit. This is a case study we looked at where a large country hotel was being built by owners that had entered into liquidation. And my client had bought this property for 12 million. So next slide. Thank you. So the legal pack, the due diligence from the vendor solicitors said exactly that, and I'll read that out. The company has not incurred any expenditure which qualifies for allowances under the Capital Allowances Act of 2001. Now, it's a simple, straightforward, bald statement, and clearly, to my experienced eye, that is a statement of a lawyer who is trying to protect himself from getting sued, but who doesn't actually know what he's talking about. So we were able to look into this in a little bit more depth, and the next click should reveal the outcome. We were able to find almost £10 million of allowances from something where the lawyer had said there is no expenditure that qualifies for allowances. It saved £1.8 million for the purchaser and reduced their effective purchase price to basically they got this hotel at half price. So that, yes, the numbers are large. Yes, it's an extreme example, but hopefully it illustrates why it's always worth digging a little deeper and never take anything at face value. Lawyers don't understand this stuff. And that statement there that was clearly designed to protect a lawyer from being sued could actually have had the opposite effect. It was a great result for my clients, but if I was a creditor of the company that had gone into liquidation and found out that they'd given away £9.5 million of allowances for nothing, I would not have been too happy with them. So the sooner you can consult a specialist, the better. So I'll do a quick topical update then. The super deduction, this is coming to an end next March. This is available for corporation tax only and gives a boost of 130% tax relief for main pool plant and increases special rate pool plant to 50% in year one. There are complicated rules on withdrawal, which are going to become more and more in point. Any clients with December year ends, December 23 year end will straddle the withdrawal of super deduction. So you'll need to consider how that is actually processed through the tax comps. I've said this time and again, nothing is as simple as it should be. In an ideal world, you'd have something bought on the 30th of March 23 that got 130% relief, but no, you get a relevant year end to give you a relevant percentage, which is based on the number of days of the year end before March 23. It's unnecessarily complex, but it's something to be aware of. Don't just assume it's straightforward. Next slide, please. Yes, the mini budget. What do we all think of this? I saw Ian Hislop describe this as kamikaze, which I thought was very amusing. There was a lot going on in the mini budget. Obviously, the two main points for capital allowances, I'll constrain my comments to those, which is probably for the best. The annual investment allowance, I described this as the yo-yo allowance earlier. We've been calling for this to be set permanently for as long as I can remember, and that has been done. Now that has been permanently set at £1 million. What permanently means in politics and tax policy is up for debate. But this was a no-brainer decision, and it finally allows businesses to develop multi-year investment plans with some confidence that the tax position in 3 or 4 years' time will be predictable. Everything else about the AIA stays as it was. It's still shared between a group. It's still only available on plant and machinery, and you still need to think about how you allocate that if you're anywhere near the AIA limit. But at least now that's, you know, a predictable and reliable tax relief. Investment zones were also introduced, giving various advantages. 100% first year allowance for P&M and a boost in SBAs. We're still waiting for details where these will be, how many there'll be, and the size of them. But potentially, I mean, they're kind of a resurgence of enterprise zones and a bit like free ports. So it still remains to be seen the detail of these, but hopefully over the coming weeks that will emerge. Next slide, please. Oh, okay. So the CA consultation, the Treasury released a consultation back in July, which, I mean, that again, that feels like an age ago. There's been a lot of water under the bridge since July. I think we've had 3 different chancellors since July, and bets are being taken on how long the current one will last. So we'll see how this pans out. It was an acknowledgement at long last that apart from the super deduction, which I've discussed is temporary, the UK is very uncompetitive in its fiscal incentives, capital allowances, investment regime, particularly post-Brexit, post-COVID. The global supply chain and just-in-time supply chain has been proved to not necessarily hold up to the stresses that could be put upon it. So CAs, I think, can encourage resilience, frankly, in the economy. If we're going to bring manufacturing processes onshore, repatriate them to the UK, investment incentives are vital to do that. In terms of international competitiveness, there's the OECD talking about a 15% minimum tax rate. Whether that's adopted nationally, whether it's enough countries will adopt it to make it a de facto, is still, again, that's still up for debate. But if there is an effective 15% minimum CT rate across the world, capital allowances are going to be the front line of the battleground to attract inward investment. Net zero, there's a question about ECAs and environmentally friendly tax relief. There isn't a specific tax relief that's environmentally focused, but there are building regulations. And if we have ever tightening building regulations and EPC requirements, if we couple these with more worthwhile tax relief, then it will encourage building owners to renew their stock more often and to refurbish more often and bring forward any benefits that the building regulations will impose. The final point there is inflation, of course. Mexico, I think, is the only country that actually recognises that inflation erodes the value of tax relief unless you get 100% upfront. So that's, with inflation as it is, that might be something to consider. 3 main suggestions. Higher PMA is an obvious one. A payable tax credit, much like land remediation relief, but for companies that have large losses carried forward, as a way to relieve those losses and encourage investment in plant and machinery. And the final one was the AIA that was enacted in the quasi-nomics budget a couple of weeks ago.
Russell, thank you very much for that. We do actually have a questions come through, which we've got a minute to go, so we might as well get that answered if we can. Is it possible to claim structures and buildings allowance if the property owner is renting the property to another company?
Yes. Either the property owner can claim, or it depends who we're acting for in this scenario. Yes, the freeholder can claim if they built the property, or equally if a taxpayer takes a lease on that property and then incurs any expenditure on fitting out on that lease, then that construction expenditure can also be eligible for the SBA. So you can have, if there's 3 or 4 different leases and subleases, you can have 3 or 4 different SBAs on one property running simultaneously, which is where the admin burden comes in. It can get quite confusing, but yeah, there's no restriction along that.
Thanks, Russell. Thanks a lot. Okay, well, that's us done. Thank you very much to our speaker today, Russell, for that fantastic insight into the landscape of capital allowances in the UK and what the future might look like as well to make us more competitive. Thank you to all the listeners today. As usual, we'll be sending these slides on to everybody straight afterwards and asking for feedback to ensure that we've hit the areas you wanted to hear about today, and also anything for the future as well. Russell's details will be at the end of this slide, so if you do have any further questions, please do fire them through to Russell. And without further ado, enjoy the rest of your day. Thank you very much.
Thank you.